Okay, this is going to be a new experience for me. I'm going to, I should tell you something. I woke up today, had a little bit of wine last night, not a lot, and I can't see properly. And I want to talk to you today about Petrozuata. And what I did is write up this case. This case is considered by Harvard Business School and a whole bunch of others the deal of the decade. They must have had some kind of Academy Award kind of dinner. Some bankers must have gone up to the podium and said, "Oh, congratulations on this deal of the decade, deal of the century." And then it was nationalized. So I'm going to make a series of cases. Now, you can say it was nationalized just because there's some crazy idiot in Venezuela, Chavez. Okay, and I'm not going to get into the politics. I want to get to the finance. I want to understand if you could have said, well, maybe this famous case is not quite as wonderful as we all thought it was. Now, what we're going to do, I'm only going to do in this one, I made a whole bunch of silly little models for Petrozuata, but we're just going to use this basic data for the case. Okay, there's somebody coming. People may be looking at me. What is this man doing? Talking to this computer like this. Okay, we're going to look at project finance. The first thing we look at is the sources and uses. Now, on the sources and uses, something very interesting here. Everybody, when they computed kind of, here's the paid-in capital, here's the debt. The reason this thing is so famous is this debt, if we take this debt divided by the total sources of funds, this debt was just about 60%. Now, I don't really know if you should do that. The operating cash flow, that's how much they were making. Let's say there's debt paid for some oil wells in the ground, and these oil wells that the debt paid for are producing some cash flow. Do you really call that equity? That's not money shareholders actually invested in the project. If you want to take the money shareholders invested in the project, you can take this and this. Okay, now, whoops, on time. The total capital that was actually invested. If you talk about, corporation invested capital, I think you talk about how much was invested. Say, okay, well, maybe this is like retained earnings that's been invested indirectly, maybe, but okay, whatever. So if we take this divided by this, whoops, shift control 5, this, excuse me, this divided by oh no, come on, what did I do wrong? Oh, of course. Some of the totals. If you take this, then there's a 77% debt to capital ratio. I don't think it's worth getting into that too much. This is how much money people really actually put into the project. And that's the starting point. Whether you call this some sort of retained earnings or you call this equity amount, I think it'll be debatable now. That's really not the subject of this video. This video is meant to show, okay, and this is before we get into the really interesting issues. The interesting issues are just what is the production cost. It's never mentioned by Harvard or anybody else, or all sorts of these write-ups. They never mention actually what's the cost of oil. If the cost of oil out of the ground for this case is something like $10 US, $8 those bills, I haven't computed it yet. You'd say, how in the heck you think there's not political risk? And then if this project, which I suppose the very first thing you do is, if you saw this thing in the project, the very first, well, so there's an announcement for the next stop. The very first thing you do is you just put the equity inflows and outflows together, and you compute the IRR. Now this IRR is an almost senseless statistic in this thing. That's the true outflows. 26% doesn't mean a ton thing. If you want to figure out why don't we accumulate these cash flows, I know, I'm going to do something so bad. I'm going to compute a payback period, but you can't even, because Excel's a little snobbish on this one, you can't do it without writing your own function if you do it fancy. But if you put a match of 0, and then we see, well, how long, and this is when we really put all our money in. Okay, it took us 4 years to pay back all our money, and that doesn't even count this one. If you say, okay, we put in about, what was our equity investment? If you sum up all the equity investment here, it's 631, and then you say, okay, we're going to start our project about here. By the time we've run the project a few years, we get $2 billion. I know it's not IRR, I know it's not NPV, but the IRR has almost as many problems as the always right there. Okay, I don't know how much background noise there is now. I'm off the train and this, kind of horrible lounge now. This 26% IRR, when the IRR gets to these kind of levels, it just becomes pure and utterly meaningless. This is an enormous IRR. You just look at the numbers they took 550 out of their pocket, 200, 200, 200, 200, 200, 200, 300, 376, 200 million, 200 million. To say okay, to benchmark this IRR to something is I'm sorry, it's just simply ridiculous. Now what we'll do is something a little differently. I think I want to make a graph. I want to make a graph of how much debt service they have compared to how much cash flow they have. That's the classic kind of graph. Now, what we could do this is almost an exercise really in simply making a graph more than anything else, but the really important part of this is that, so I'm putting the cash available for debt service here, and then I'll put a minus sign on the debt service, and then just above, let me see, they have it in a whole bunch of lines. I don't know how this is going to work. How about this? Let's try this. No, why don't we just put a? I hope you can hear me. I don't want to irritate. I don't want to be a loud, irritating person. Okay, when people see me talk to my computer, they might think I'm talking on the phone and acting like I'm so important that I have to be on the phone all the time. I'm really not very important, in case you don't know. This is, so we put these in, now we have some blanks, and then let's just copy this all the way down. This goes down to the end of the concession period. Now, if we want to describe this project, I think the only one you really wanted to look at is what happened during the construction period. How much of money is spent out of the total on this upgrader, which was Shift Control 5, 60%. That's mainly what they were doing. And then if you take a pipeline
and add that to the amount, shift control 5, and we get 72%. Production was not the issue really in this case. This was a project about after production is kind of there, developing the production and getting it out of the country. So once we have this, here's again the key issue. You can't put anything year here. When it's blank, it's gonna hopefully not graph anything. And then, if you've watched any of the videos, and if you haven't, it really doesn't matter. Here's what we do. I'm pressing, if you could watch my hand, it's pressing the F11 button. And then it says cash available for debt service, and debt service on the bottom. We have the years on the side, and we can put title here, but let's wait with the title. And perhaps just to make it a little bit of a different looking graph, I'm going to make it, I think, into an area graph. And when we make it into an area graph, we want to not stack it. So this is the correct one. So this is supposed to tell you a little bit of a story. The cash flow comes down here. This decreases when the royalty payment goes up. They assumed an oil price which was flat, and I think probably increasing production costs. The blue area is all the dividends. The red area is the bond payments. This is an enormous amount of space, and the oil price can come. This is the DSCR here. This measures how low the price can go. Why don't we, if you press Control 1, I think, on this, it takes you straight to the axis. And let's just make it a little bigger. How about this? I can't, where do we get the format? Oh, I think we just go to the Home tab. I'm going to make the years a little bit bigger. What happens then? Then, okay, we can see them a little bit more. I'm going to make this a little bit bigger. How about make it 14? And now let's compute two things. I think we should compute the LLCR and the DSCR. Now, do you see where is the debt service? Do you see where it says total debt and debt declines? Now, if I pressed Control and Spacebar. Now, if I press Shift Control Plus, you can get a new line. And let's put debt issues. How about here? And repayments. Okay, so if we take this one and we, this one minus this one, okay, this is how much debt has been issued by the project. This is this famous bonds that was issued, and then this is this would be the debt repayments, okay, and then if we want the, where is they say here's the total debt service. So if we could compute the interest now. The only problem is we don't really have any. I hope the interest is capitalized. So why don't we put debt cash flows? How about this? Now this might not work. Okay, so what I'm going to do is say, well, let's put a minus on the amount that was issued here in this first period. It's really everything split between the first period and the second period. And then we'll put the debt service here, but we'll put a plus. Okay. Oops. What happened here? A minus, and a minus, of course. Okay, so that's our debt cash flow, and we can put IRR on the debt cash flow, and we get we get about a 6.26% debt interest rate. It might be a little low because there might have been some interest on here that's not captured somewhere. It could have been captured somewhere else. So, but we'll use that. So, here's what we can do next. We can put the DSCR first, and the DSCR is simply this one divided by this one. And what we better do is first press Shift Control 1, and then if you put a if statement, and when you do this you just put an if statement and go to the bottom, okay, and this gives you the DSCR, so you can see there's an enormous amount of really coverage. On the end it doesn't, it's silly, it would be silly to take the average of this, okay. Now, we can put, once we have this, we can put the minimum like this. Okay, now, because of these extremely large areas, you can say, well, that doesn't really measure, that would say that the oil price or the cash flow can come down in half. If we, well, the debt service coverage is 1.5, you would say, well, okay, the debt service is 50, the cash flow is 100. Actually, the cash flow can come down by 100%. It's really, well, we could do the arithmetic. Let's just do that. So, if the cash flow is, what did I say, 150, and this was 100, then the way we'd interpret that would say, okay, well, the debt service coverage ratio is this. Or we can say, no, the cash flow can come down, but we want to get, well, yes, if the cash flow is, the cash flow can come down by 66%, 1 divided by the DSCR. Excuse me for going so slowly on that. You could have figured this out. So if we take this, we can put 1 divided by this. So the cash flow could come down by, I got that. The cash flow could be 47%. Of what it is, or if we want to state it differently, it could come down by 52%, and we'd still be okay. So whatever oil price they had, which was this absurd oil price here, even this oil price here could come down by 50%, and you'd still be making this 26% IRR. And then for the gall of these people to say, oh, it's all about some wacko in Venezuela, some political, horrible anti-capitalist. Maybe all that's true, but when you are extracting that much money from people, whatever. Okay, now let's put the PLCR. Now what that measures is, it measures a little bit different. It stands for the project life coverage ratio. If we put NPV, and this time we go to the debt IRR, and we first get the total present value of the cash flows at the debt rates. Now we could take that and we could divide that by the NPV at the same IRR, and we could take that and compare that to the total debt service. Okay, and then we get this PLCR, that says it's 3 times. If we do our little analysis, it's 1 divided by 3, that, and then we take 1 minus that. So if you do it on that basis, the cash flow could go down by about 66%. I mean, the cash flow would still be okay, and again, that has to be taken in the context of those oil prices. And to say there's a lot of oil price risk in this would just be kind of ridiculous. Now we could also do the LLCR. That's a little bit trickier, because in this case we have to take the NPV only over the loan life. So we'll put an equal sign. And how about we'll just look at the debt service. If that's greater than 0, so we just can put a little switch there. So we take just the NPV over the loan life. Okay, and if we want to do a little bit fancy, you can put NPV and you go over to the interest rate with the debt rate. Okay, and then we can first take the total debt service, multiply that by the amount that's true, like this, close that bracket, and then divide that by the NPV of the debt service. Or if we want to do it a little bit differently, we can put SUMIF, and we can look at this one and only take this one. We can click on this one and only SUMIF when this one is greater than 0, and then we can SUMIF that same line. So it's a little bit more complicated, and I did it wrong because whenever you multiply something, you have to press Shift Control right arrow, and I still did it wrong because I said it was going to be greater than 0, and I apparently didn't type that in. So Shift Control right arrow, and it's still wrong. Just let me pause it. I actually think this one is right. What I did here is I took the NPV of the debt service. Why that didn't quite work? It must be the interest. The real debt issues we made were this one. If we I'll do this one again. SUMIF, and let's click on this, the amount we have of the debt issues. Put a comma and just make that greater than 0, and then put another comma like this. Okay, so when we do the PLCR, that in theory the NPV should have been identical. Why it wasn't, I'll have to think about that. So the PLCR really was 34%. The LLCR was this. Now, the oil price reduction. Let's put oil price reduction. And how about, why don't we put it over here? So this says how much could the oil price go down with all of these things. And if okay, we can take this down here, but so actually we could put the oil price, so we can say, well, this can be let's start with this one. Okay, and remember we said, okay, we can put 1 divided by the DSCR. That gives you, it can be 47% of the oil price. So we could put oil, break B, the oil price. Okay, let's just take this 18. How about this? I'm gonna move this up here. I'm just kind of doing a little bit of experiment. So with this, and we divide that by the DSCR. So we could get an oil price of 8 with the DSCR. And I'll put DSCR. And then we can put break even oil with the LLCR, PLCR. That's going to be the most dramatic. And that means how much does it have to go down before we cannot pay any of it? And we can just divide that. It can go down to $5 and PE oil price. So there's really no oil price risk in this one. There was no downside oil price risk. In fact, what there really was upside oil price risk because of this extraordinarily high IRR, which doesn't really mean anything. It means, I think, I'm laughing. I shouldn't laugh how arrogant, but it means a whole lot less than the payback period, which, if you ever in a Harvard case study said, let's look at the payback period instead of the IRR, I think you'd be smacked around and thrown out of the university. And if you did that, well, I went to the University of Chicago, it would be even worse. So now what we can do is we can put this title on the. We can just put this whole thing on the title of the chart now. Okay. And it's way too long. What a horrible title. Now you can't split it. Here's what you have to do to split it. You have to go to this one and go right to the beginning and press alternate enter. Then when you do that, it puts it in here, and let's make a little bit of a larger. That's too large. How about this? How about 20? Is that okay? Okay, so we can get. I would say. Oh, look at this! It put this in here, so we better move that one now. I hope this doesn't mess everything up. For me, if you want one picture, here is the idea. If you want one picture that tells the entire story about the project, this tells how much tail you have, how much extra space you have at the end, how much buffer you have at here. The PLCR includes all the space. The LLCR stops here. DSCR is just a period by period and finds the minimum. Which is the real measure of the buffer? I'd say PLCR. Banks would like DSCR. Maybe a compromise with some other portfolio people might say LLCR. But the picture is really what tells the story of this whole thing. And here's the cash flow. And I'm going to stop this video right now.